Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Globally, it's been a pretty good year so far for the tech stocks. The likes of Apple and Microsoft have done really well, while Nvidia has ridden the AI boom to become a $1 trillion company. But what's it all mean for the local tech sector? Remember, this is general information only, and you should speak to a professional advisor before making investment decisions. Elise Kennedy is Head of Technology Research and Director of Equity Research at Jarden. Elise, welcome back to Fear and Greed.
Thanks for having me again.
Okay, what's going on in the tech sector? I don't know that it's totally rational at times, Elise. We've had quite the run this year, notwithstanding a few bumps and bruises.
Absolutely. I think that the market volatility isn't necessarily based on fundamentals, but we rode it down and now we're riding it up. And who knows over the next couple of months as we see rates around the world move and inflation try to normalize. I think that's where we get ebbs and flows. But as I've said, straight from all the conversations we've had, finding those businesses in between there that are going to continue to see and sustain growth. There might be some ups and downs and better entry points, but fundamentally, those are the ones that are going to turn out to be the better long-term holds.
I want to get to the Australian market in a moment, but I just want to get your view on a few companies, Nvidia being the obvious one. It makes computer chips for artificial intelligence. I mean, it's kind of high-end computer chips. Is it a bubble, or does it actually have the fundamentals to have? I mean, it's up going to 150% or something so far this year.
I think AI as a thematic is a really important one. It's not new. We could have turned back a few, months or years ago, and it was very early stage when some of the bigger tech guys started to invest in it and it started to pop up in all presentations. But yes, there is an element of exuberance that exists within that, and any type cycle. Something that I referred a few clients to recently was the Gartner hype cycle. So if you go and look that up, you'll see there's this irrational exuberance that comes through into the market and everyone gets excited. It then drops down, normalizes, still higher than where it was before it starts to take more of a normalized turn. So I'd be inclined to think that that may be what we're seeing at this point in time. So definitely relevant, but yeah, it's had a bit of a good run, hasn't it?
It sure has. How does Wall Street stocks like Nvidia, but you can add, Microsoft, Apple, Tesla, Alphabet into that as well. How important are they to what happens in the local market?
I think that overall they have a sway in the local market in terms of if that tech sector is rally, you tend to see a lot of our global tech names take a lift in valuation. Is that a justified rationale? It's kind of how markets work. It's like if you see the NASDAQ rally, your electronic trading and some of those other more less fundamental orientated guys will start buying other indices globally and that will drive it higher. So I think that comes into play to some element, but then also they all, impact some of the guys in the domestic market because some guys might be leveraged to them, might be utilizing their technology. So there's a few ways that it does flow through.
Okay, so let's talk about some of the local companies. We have to start with WiseTech Global. Has been a great performer this year, up more than 50%, notwithstanding a bit of a fall late last week. Where's that one sit? Why is that one doing so well? And what do you think? Where do you think it's going?
Yeah, look, the valuation is always a challenge on this name. Right now, it's trading on a multiple that is so ridiculously high versus some of its peers, an EV/EBITDA of 72, even zero, which everyone else says is expensive at 60 times, versus some of its peers will be around 30.
And so I'm just going to jump in. So just explain that. So when you're talking about trading on a multiple, it's actually a multiple of earnings.
That's right, a multiple of earnings. So that's just saying, what are you paying for today in 12 months' time? Because, if a stock is going to be growing exceptionally high, you can justify and grow into that. But it's a matter of putting what its value is over its earnings.
Okay, and then to give some context around that, so you're saying 72 times earnings, WiseTech Global, a bank would be like 12 to 15 times, is a guess?
That's exactly right. A bank or anything that pays more of a earnings-based number, which to me, I think is an increasingly important factor for investors as cash isn't coming free anymore in this environment.
Okay. So 72 times, very expensive to get into WiseTech.
Yeah. That's right. So it has had a very expensive run, and I think there's some risks looking forward. Freight volumes are falling. There's risk to margins. You may look back at some of the acquisitions that they did back in FY19 and 20, they impacted margins and saw them fall by 550 basis points. But whereas you look at where consensus in the market kind of has those forecasts for WiseTech's margins, and they've got no impact from the acquisitions that they made. And those two acquisitions were the biggest that they've ever done, much bigger than those back in 19 and 20. So I think, there's some causes of concern long term. Sure, this is a great stock, generates a lot of free cash flow, got the benefit of global contracts, but I think it's becoming increasingly pricey.
Okay, Xero you mentioned as well. You said 60 times. I didn't realise that was as expensive as that is.
Look, it is more expensive, but I'm probably more positive on that name. We just recently published a report around looking at what they can do compared to some of their peers on margins. We compared it to MYOB, which is a name that comes and goes from the market regularly. And they used to achieve EBITDA margins or free cash flow margins of around 40%. And Xero right now is doing 3% free cash flow margins. So that just to me is a flaw as to where the potential long-term earnings growth of the business can get to. And if I look at MYOB, they were doing desktop, they were doing enterprise, different segments that require additional investment that I would be inclined to think that would be able to get higher for Xero, who's 100% pure play SaaS, and the new incoming CEO is really stripping that business back to its core of accounting. That to me, whilst it looks expensive on that 12-month basis, as I mentioned, I think it's more likely to grow into its earnings and have a few of those trigger points to be able to get to a better valuation to bring down that or increase earnings that it will bring down that multiple that I mentioned.
Stay with me, Elise. We'll be back in a minute. My guest today is Elise Kennedy, Head of Technology Research and Director of Equity Research at Jarden. Okay, what about the online property groups, REA and Domain being the main two? We are seeing the property market turning, or in some cities it has turned, definitely. What's the outlook for those guys?
You're right. Like, house prices have held up relatively well, but listings volumes are still at record low. But these share prices for Domain and REA have already largely priced in a lot of that potential uplift in listings volumes. Now, we also did a research lately and looking at just where house prices have grown and, what is REA putting through in terms of the price increases for them, because they put through double-digit price increases for the listing. So that impacts you and I when we go to our vendor and we go and we say, what's going to be marketing spend for this campaign? They're going to say it's X. They've put through a minimum of 10% increase, sometimes up to higher double-digit growth on that. Whereas if house prices are growing 5%, they've grown that over the last 10 to 20 years, every year on a CAGR basis, and then REA is going to try and keep doing 10% price increases, that means that as a percentage, it's going to be $5,000 more in, say, 5-10 years' time. I don't know how much our budgets will be able to sustain that. Yeah. So whether they have to disintermediate the real estate agent to be able to take a cut of their commission, which I think is going to create conflict, I just think it's going to be a harder slug given how high expectations are for these two names at the moment.
Okay. I also want to just ask you about the buy now, pay later sector, because it was an incredible sector for a few years. Obviously, Afterpay led the way there. That's now been sold to Block. We still have companies like Zip and Sezzle listed on the ASX, but with regulation coming, are they companies that we should be thinking about?
I think they're really challenged, even though valuation is where it is. We find it hard to be able to push either of the names. I think they're doing great with what they have. Management, pulling as many levers they can on the cost out, but you've got risk on the credit side. Sezzle just did a recent print that showed still very good cost out and delivering on target there, but those credit numbers over in the US started to tick up. So I think that's kind of a bit of a playbook if we do get, softer economic backdrop even from here. It's just ones that are harder for me to go and put my hand on the table and say, yep, let's go get these ones versus some of the others that have some fundamentals backing them.
Yeah, and then I have to just quickly ask about Seek and car sales. We're running out of time, but again, sort of traditional tech companies in a way, a bit like REA and Domain, Seek and car sales. What are their prospects?
Yeah, look, I think car sales is going to have an upgrade into the result. Just the used car market and the new car market is holding up well in Australia. That's benefiting them. Seek, I am surprised at the jobs market, how well that has held up. We're still seeing vacancies relatively lower. We're still yet to see the impact of migration, but I think that everyone's thinking this is the last upgrade. This is the last upgrade. So it's probably not getting as much of the benefit, and investors aren't going to buy that as much as they are going to for car sales.
It seems to me companies like Seek, REA, Domain, car sales, they're very traditional companies. I mean, they're tech companies, but they're based on very traditional industries and cyclical industries. Whereas things like, WiseTech Global, I suppose, is the example, much more innovative or something or other. Is that a fair to say that? Therefore, it trades much higher.
Absolutely. I have to agree. And that's where technology, because we're still so earlier phase in most of the adoption curves, that's where the valuation is for us justified to be higher on those multiples, which we discussed earlier, versus some others that, you compared it to a bank that really doesn't have as much growth or as much levers, is leveraged to other macroeconomic forces versus, hey, we actually need to drive adoption of, say, Xero's accounting software or logistics software when it comes to WiseTech. And that to me is really why there's a bit of volatility when it comes to markets in the short term. But longer term, if you believe in the technology which they're bringing in, the economic moat and the competitive landscape which they've created, these companies will generate more dollars in the future versus the others that might go up and down.
Elise, thank you for talking to Fear and Greed.
Thank you as always for having me.
That was Elise Kennedy, Head of Technology Research and Director of Equity Research at Jarden. This is the Fear and Greed Daily Interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.